Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. My name is Seth Krussman, joined here once again with Ben Brayshaw and Dan Mickelin. How are you guys doing today?
I'm doing great, Seth. I'm actually looking forward to this show. I think it's kind of one of those hopeful shows.
Yeah, I'm excited about getting into it, and there's a lot of good information here, and it's a topic we love talking about, and just getting people's minds straight about just some super common misconceptions.
Yeah. Speaking of, that's a great segue into what is the title of today's show. It's Debunking Uncle John's Myths. What in the world does that have to do with Money on Tap or financial planning? Well, we find that there's a lot of times that we're sitting down with our clients and other people, and it seems like everybody has this Uncle John or Aunt Susie Norman, whoever it is in your family that is the know-it-all of everything financial. Like whatever it is out there that you bring to the table and you have a question about, they know everything, and you can never ever be on the other side of that conversation from them, because you know what? You don't know, right? And they know. Anyways, we've had so many of those conversations. We thought it'd be fun to just title a show around this person, this persona in all of our financial worlds. And what are a lot of the myths that they bring into the conversation? Usually it's, unsubstantiated by any facts, data, or otherwise. It's somebody that they heard about, or, whatever. It's their preferred experience that they want to influence you with. And we'd love an opportunity for you to write in with some of your favorite stories, or some of the people that have been big influencers for you. And maybe they have some myths that you guys are wanting to get some questions around, or questions answered around. I love it when I hear myself and I'm like, oh, no, that's not what I meant to say. This is where we're going with this show today, folks. It's going to be a lot of fun. You can reach us at 855-226-8551 or info@yourmoneyontap.com. And we look forward to having those conversations with you here at Money on Tap. You know what? I just got to ask, what is it about this show for you guys that, actually kind of gets you interested or intrigued?
Well, for me, Seth, I just love the idea that we can really help people get a different perspective than maybe, not walking into their own fears and concerns every day financially, and, just be able to, have a number of different subjects and topics covered by people that handle the level of three-dimensional investing and planning work that we do.
Yeah, and I think, one of the things that I like best about what we do is to be able to get people informed in the right way. I hate to see people, have made mistakes or hesitated to make a decision in the past based upon something that was just factually incorrect, or somehow they were guided in the wrong way.
Yeah, I think when we really break it down, I was talking to a CPA the other day, and he was just saying, I really want someone to meet with you, because it seems like every time he meets with somebody, they have a real hard agenda on what to do business in. And he's like, what I like about you guys is that you can literally look at all the different avenues, because you can do business in so many different facets that you can really bring to table a plan and a suggested, solution that fits both the goals and the client's wants and needs and feelings of comfort. And I think that's really what makes us and sets it apart differently.
Yeah, and not to go too far down the road, but you brought up a good point there. And I felt like I had to say this. A lot of times people get this bad advice, or they hear just incorrect things because the person they sought advice from is somehow limited by license or experience in what things it can actually discuss. And when you come here to Brayshaw Financial and you meet with us and discuss these things with us, just understand that we have access to offer the entire gamut of financial product. We're not limited by anything, and we're going to give you the good, honest approach and our thoughts about how each one of these different financial tools, has a place in a portfolio.
Cannot wait. So we're going to head that direction real soon. But before we do, it's time for Money in the News.
And first up here from the New York Post, which is always a great stop for a quick, entertaining read. But home asking prices tumble at a record pace as mortgage rates surge. And this, I think, is something that, a lot of people saw coming when, the Fed began behaving as they have and really cranking up the interest rates. But, about 7.9% of home listings dropped their price in a 4-week period ending on October 9th. Which is significantly up from only 4% a year ago. So what's going on here, and I think it's kind of easy to predict and to see, is mortgage rates go up, the appetite for home buying is going down.
Yeah, I mean it's kind of standard. I mean, they talked about as mortgages are getting more expensive, 51% more expensive than a year ago, right? I mean, it's just a crazy. It's really crazy. But there's kind of an interesting shift. And I was talking to a realtor the other day about how, kind of the more expensive homes, the kind of the wealthier end of that space has really not been affected because a lot of people are, the wealthy are just buying homes in cash. That's just kind of how they operate. So that's kind of interesting how that has not impacted the kind of the higher end north of, $500,000, maybe even $1 million home. I don't know what level he was referencing. But yeah, if you're looking to get a mortgage and, now it's like, and I've contemplated this, for our portfolios, and we've talked about this, that people who are, people switch homes for a better kitchen, bigger space, the porch they always wanted, the deck, the yard, whatever. But when mortgage rates go up and you have a mortgage at 3% and now mortgages, 30-year mortgages north of 7, probably going to 8, you're like, what I can kind of do with, quarter of an acre less, or I can always go to Home Depot and spend $20,000 on cabinets than add $100,000 of mortgage cost to my life over the next 30 years. Like there's that conversation that's really happening and getting back to ground zero of, are we going to fix up or go? And I think that's a real good, interesting conversation about investing is, where are people going to spend their money?
Yeah, I mean, there's those are difficult decisions to weigh, right? And I think people's expectations and desire list probably slims down a little bit in face of the increased cost, and that just makes sense.
Folks, this is interesting to see Redfin in the top of the leaderboard of the data that's coming through. It was just a minute ago that it was Zillow, and also it's also interesting for me to see how the industry is repositioning itself from a marketing perspective. I'm hearing, I don't know, whatever fast mortgage company out there is saying, buy today and then we'll refinance you for free when rates drop down the road. And so they're kind of the phrasing around this is this like inevitability of like, we know that you want this thing, you can't do without it. So we're going to go ahead and do it for you. But guess what? We're going to take care of you down the road because the rates are coming down. And I've heard more than one person in the industry really start to kind of, hitch their horse to that idea. Do you have pre-worn Levi's?
I do.
I like the pause in between the articles there. It's like, well, yeah, we're doing it. Pre-worn Levi's jeans from 1880s found in mine, sold for $87,000.
1880.
Yeah, so mine
not
aren't
1980,
that old
1880.
or that worn.
Yeah, I might have some jeans from the 80s, but not the 1880s. That's for sure.
Well, this is really interesting. So, yeah, they found a pair of jeans in an old mine from the 1880s in New Mexico, and they sold at auction for $87,000. This is an article from Fox Business. It's by Landon Mion. And it's just interesting that, it's just they've holes, paint stains, all visible, just folded up in there. It's just kind of crazy. So someone must have been changing from their work clothes to something else and never went back to the mine.
Just left them there.
Just left them there. So, nobody knows what really happened there, but it's actually just a really interesting story because the story goes on and Fox Business goes on to comment that inside the jeans it was actually noted, they're bringing this to the forefront, they're actually noted that these were white labor only. It was just very, very, so back in the day, there was this whole movement of the hiring anybody who wasn't white inside your company. Mostly it was the Asian population that they were focused on at that point in time, the Chinese workers, because there was so much, problems in that space in our culture. Levi Strauss has come to the forefront and said, hey, listen, we're sorry that this happened in the 1880s. It was a cultural event at the time, and that they believed at that point in time that was going to sell more jeans. They were capitalistic at the heart.
Yeah, 150 years later, you got to apologize for marketing lines, But, what it was also – a couple things were incredible about this, and, they're still like you're able to wear them. They're in good enough condition to actually wear. But for now, they're going to be, in a safe deposit box, and I guess you can ask these owners, the purchasers, for time to go, check them out and witness this. But ultimately, they want to have them be placed in a museum, which I thought was there's just a lot of interest around old clothes here that I never thought was anything that would matter, and the price that they paid for them, I just found absolutely astronomical.
Well, every time my wife wants to throw something away, I could always say, listen, we're only like 130 years away from this thing being worth like 80 grand. So, in reality, right? How many times does my wife want to go through? I'm just like, what are you doing? These
are, hidden treasures here, future gold.
I'm just waiting for the fad to come back in style so I can have the only shirt that still exists that looks like this. So, it's an interesting article. Next up, we have Bank of America survey screams capitulation with rally set for 2023. This is by Farah Elbarai. And, this is pretty interesting. There's a lot of moving parts here, but basically there's a nearly record number of those surveyed said they expected a weaker economy in the next 12 months, while 79% forecast inflation will drop in the same period. Now, what really brings this into line where, hey, listen, capitulation, we just talked about this on one of our last shows. When capitulation happens, the market usually moves forward. And what they're really getting into, and I think this is interesting, is that it's the highest that they've ever had, but 6.3% of portfolios are in cash on average, which is the highest since April 2001. And 49% of participants are underweight in equities. These are two huge items that say, hey, listen, people are ready for a rally.
Yeah, and I think this – there's an expectation built in. And how they got this information, by the way, they surveyed 326 fund managers who collectively managed $971 billion. So these are people in the game here for sure. And they're expecting, significant policy change, particularly around, I'm sure, interest rates. They didn't specifically lay that out. But there's an expectation here, like you just referenced there, in the next 12 months that, interest rates will start getting cut again by the Fed. And that's kind of where they see this 2023 rally being sourced out of, is just, the good news and the sense of relief that'll come with that will just drive people into the market.
Yeah. Interesting how the, earnings season gains here over the next period here. 83% of the investors expect global profits to worsen. It's an interesting testimony here to how these things historically have worked. These are all key indicators that we're taking a look at that are just starting to escalate the bottom is really where I see this article saying. It's like we just have all of these things pointing closer towards what we're getting there. Last show we were talking about, are we going to get to another tipping point of over 30%, or are we going to see things right now start to solidify? And the most significant piece of data that I loved out of that last show was Dan bringing to the table how October is it. Historically, everything ends in October on these markets and their bottoms. So, my hope and prayer is that this is the October and not next October.
Yeah, there's something else I saw here in this one that I thought was good, and another 12 months of this would be tough to stomach. But what was interesting,
there's only so much opportunity I can stand.
The survey, these fund managers were bullish on a couple things that we are as well, and we've kind of been beating the drum here. Particularly healthcare, energy, and consumer staples. So these are things that people run to in tough times, and it's just getting back to that core principle of, when times are tough, invest in the things you just got to have.
Yeah, and then the idea that there's this large percentage of people that feel that the dollar is, overvalued, and that's concerning too. It
kills trade. Yeah, it's a big deal.
It just kills trade, and so there's a lot of moving parts here that are really. I really think we're at a fulcrum. We're at this point. We talk about the tipping point, but it's kind of like standing in the middle of a seesaw and you're keeping it balanced. And every day the market goes up or down with how little weight is moving on one little thing or another. And, we're at that kind of 24, 25% loss from the high. And there's a lot of concern that, hey, are we going to hit that 30% threshold that we talked about in one of those shows? And is that going to really push us south below to a completely different kind of recessionary, event in our market? And if that happens, that's one thing. But we have all these other things that are really looking good and strong. And there's, hey, we've got the midterm elections, we've got this, we've got that, we've got all these different things that really look positive. And if the midterm elections, we always have a positive year after that. It's like, so there's a lot of really interesting pieces here that are at play. And I really think someone's standing on the seesaw in the middle, balancing left or right. And which way is it going to go? And honestly, guessing is really not the right thing. So it's all about time horizon and managing those assets in a way that you can really be well prepared and well situated. And we're going to talk about some solutions around that, I think, today in our show with Debunking Uncle John's Myths that are really going to help some people address this in a much healthier, better way to both, enter retirement and, facilitate those concerns.
We'll just all pray that it's not Powell standing on that seesaw, protecting and predicting which way it's going to go.
Honestly, we just get Biden off of it. That would be helpful.
You got it. We're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are going to be talking about debunking Uncle John's myths. And, as I'm thinking about that, your children have an Uncle John, don't they, Ben?
We do have an Uncle John in my house, and there's some myths about my Uncle John.
He is a man of many myths, that's for sure. Yes, he is. Yeah, so join us here on Mythbusters today. We're going to have some fun. But first, we got to take a quick break. We'll be right back.
For a number of our listeners, they have a lot of questions, and you might be one of them. Today, we're just offering what we call Zoominars, webinars over Zoom meeting rooms where we have top experts, Social Security, estate planning, and financial planning experts for you to speak with, do a private consultation that way today. We're also having webinar-based Zoominars where we're going to have multiple groups where you can be part of that and enjoy that as well. Give us a call at 855-226-8551 or email us at info@yourmoneyontap.com to schedule your Zoominar.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, here's our Cliff Notes edition of Money on Tap.
U.S. travelers are getting bigger discounts in much of Europe amid favorable euro-dollar exchange rate. This is a great article, and I mean, for all of the retirees who are listening, the dollar's at its highest in roughly 2 decades relative to the euro. Actually, the dollar is worth more than the euro. It's 101 to 1. It hit parity, and then it's continued moving. So, I mean, you can go to Europe, and what used to be, 16% higher is now 16% cheaper. Yeah. It's pretty incredible. I mean, a lot of people who are looking to travel, this is an opportunity to do it at a significantly reduced rate. I mean, you can book your airlines, you can book your hotel, your rentals, car rental. You could do all of that now and be planning for it 6 or 9 months from now, even if the parity's lost and the euro climbs back up.
Thanks for joining us for this Cliff Notes edition of Money on Tap, with great tips from the pros in three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. Now here's more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Folks, we're talking about debunking Uncle John's myths today. And if you're joining us by radio, well, it's wonderful. We're glad to have you. And if you're thinking, hey, I missed what they were talking about, and I wanted to go back and have another listen, guess what? We're on a podcast too. Just take a look anywhere, any podcast venue out there. You'll find Money on Tap. And take a look through the shows. Find out what you've been missing out on. We're talking about debunking Uncle John's myths today. And Uncle John is just one of those, characters or personas that it seems everybody has one in a family that, knows everything about everything that there is to probably whatever. they just know everything. But you know what? They have their opinions about finance. And those conversations usually are pretty loaded. There's a lot of landmines in there. And if you're wanting to walk through and find the information that's important for you, guess what? You're going to have to be the one to be willing to go ahead and set aside or suspend your belief in Uncle John's myths of what they've told you about the personal finance world and create your own path and work with a team of professionals that knows how to navigate through creating a retirement or creating wealth and what works and what doesn't. Everything that we talk about here on this show at Money on Tap revolves around a concept that we call three-dimensional investing. All right, what is that? We take a look at all sides of the perspective of the issue. We bring to the table all of our licenses that allow us to, work in managed money or fee-based planning, insurance, brokerage. All of those pieces play a role for you in creating what's a successful path. And so part of what we focus on or we work through in a lot of our scenarios revolves around the insurance and the annuity world. And there's a ton of myths, and that's one of the places that we're going to spend the majority of our time today focused on is the myths around annuities and this insurance world of annuities. So with all of that, giving you the truth around what it is inside of annuities, it's going to be a lot of fun. Myth number one for us here is that annuities have a low rate of return. Why would that even be important for you?
Well, I think the one thing here, as you kind of get into the annuity conversation and the low rate of return and all that stuff is that, some people heard the word annuity and said, hey, let's turn the show off, and I think that's the biggest, mistake you could potentially make if you're the right person for it and don't realize that this might be a good fit for you. Because, when it comes to investing, there's a lot of people out there that can sell different types of annuities, but can't sell all the annuities. And then there's people who don't have that three-dimensional investment perspective, Seth, or the licensing to do the three-dimensional investing that we do to really find the right fit for some of these things. And the idea that, annuity is really just simply a pension, as we go through the different myths and kind of work through this piece, a lot of people, and I was talking to a gentleman the other day who said he was approached by a financial advisor who only wanted to sell him indexed annuities. I thought that was interesting. I was like, and he had clearly read through the lines of all the everything that this guy was pitching, and he was just kind of like, I'm not interested in that because I don't even know if what he's telling me really fits my needs because I don't have anyone to give me the full perspective. It's kind of like walking into a doctor's office and saying, I'm sick, and you go see the general practitioner and he says, hey, listen, this is what you've got. You need to go see this specialist. And you need somebody who can kind of get that full gamut. And we all understand that we're not going to go see a heart specialist when we have, something else going on with our body. It's like you go to the person who you need to see. So, which is what makes us strong is because we have the ability to do all of that, but we all have our own little specialties that we work in. And you might work with Dan or Seth or me or Tony or whoever, all of our partners, Sheldon, whatever, for those types of specialties. And that's what really makes us unique on top of the fact that we have all the licensing for that. But as we get into the annuities have a low rate of return, the piece that I think is the biggest facade is you can buy an annuity that has, virtually no return, or you can buy annuities that, and they just give you a solid, biggest guarantee income, and that's maybe an income-based annuity, or you can buy a full exposed to the stock market. If the stock market's roaring, making 40 or 50%, you could be seeing those types of returns in your annuity. And I've seen, I actually had a client who did a ridiculous rate of return, so much in the first year that after owning it for 12 months, she had made more money than all the guarantees that the annuity provided. This was post 2008, so we had that huge rally. Remember that? Mm-hmm. Bought literally at the perfect time. We actually had to write the compliance office and say, we need to move her out of this because she's so far outperformed the guarantees of the annuity that there is no more insurance covering her. And they did. We moved it and locked in all that gain. So there are annuities that can completely give you full exposure to the stock market.
Yeah, the potential within them is really not limited in any kind of way. It really boils down to, did you buy or are you considering the right type of annuity?
Right.
Because there's kinds that do all different kinds of things, whether they're linked to a portfolio of mutual funds, linked just to a major stock market index. And then you have the very simple CD style annuity that just pays you a fixed rate every year. And right now, quite honestly, there's a pretty good opportunity in those. You can get 5% guaranteed for 5 years right now.
That absolutely blows my mind. I mean, there's some fixed annuities are providing, like a minimum guarantee with the market return as an upside with a 0% loss scenario. I saw one of those out the other day. All of these are kind of in the more, conservative side. So when you reference, Dan, you can pick all these different pieces and so forth. You can literally pick the type of benefits, whether you want income, whether you want a death benefit, whether it's joint income, whether it's single income, whether you want income for 5 years or 10 years. There's all different types of things you can do, but you can also choose the amount of risk you want exposure to, which is kind of nice. And that's why there are millions of annuity options. And so when you meet with somebody, you need somebody to understand the full gamut, be licensed for the full gamut, and figure out what kind of benefits do you need. That's like one whole big questionnaire that you're going to kind of go through. Do you need these benefits? Okay, then you narrow it down to those companies that have it. Then what kind of risk? Do you want full exposure to the stock market, or do you want like no stock market exposure? And then all of a sudden, all the in-betweens of that come into play. And then you start getting into ratings. Like, just ratings of the carrier, like how are they evaluating those pieces? So annuities have a low rate of return. That's just not true. It's really your choice of how much return limitations you want to add to feel good about the value of your asset. Like people choose CDs all the time, as you mentioned earlier, because they feel good about the value of their asset, but they might have a stock account too.
Yeah, it's a conservative instrument in a lot of ways, and what's most opportune about it, and I think why it makes the most sense for not everybody, but most people to consider, is that they all come with some kind of a guarantee. They're all that kind of foundational element of a good portfolio design. And really, it's gotten to the point with so many features available that, you tell us what your goals are, we can help you find the right product. You start with what the outcome is, and then we can dive into what options exist for you.
And the other thing here, and I know Seth's going to wants to say something. Sorry, Seth. The other piece here is that when we talk about annuities, we're not talking about, a lot of people think like when you invest in investments, like that's just where all your money goes. When you actually select investments or you're working with somebody who's doing real competent diversified planning, it includes not only diversifying how your money's invested, but what your money's invested in. So an annuity never plays a full role or even a large role. It usually is a portion of a role to fulfill basically some sort of specific need. It's usually income or death. It's usually trust work associated, or you worked at a 401, a job that had a 401k all your life, and you've really saved, and you said, I need this much income. How do I make sure I have that much income while I'm in retirement? Well, an annuity can solve that problem for you. And then you just kind of evaluate the risk you want to take on to try to, how much you want to leave your family, or, whatever that scenario is that you need joint income. That's really the play of segmenting your assets among lots of different types of investment strategies, an annuity being one of them.
So most myths are based in some truth, right? Somehow, some ways. There was an experience over here that Uncle John had that made him say, all annuities have a low rate of return. And, identifying what that probably was is just one of the things I want to say. There's some legitimacy there, right? So there's the full spectrum on these annuities. And there's the fixed annuity, which Right now, one of the things that we've seen out there is the fixed annuities, which are, put the money in, you have a fixed rate of return, looks and smells, acts a lot like a CD, if you're familiar with what one of those is. So you put it in and you have a period of time that you leave the money in, and it has a guarantee on it. Anytime that we're talking about something in this marketplace that has a guarantee, one of the things that will coincide with that is a lower rate of return. May not be a low rate of return, but typically it is lower. And that's because it has a guarantee. So there's a part of that that might be very well true. And during a period of time where the rates were low and, Uncle John saw this product on the shelf that somebody was trying to either sell him or influence him was, what he needed to have, he probably looked at that and said, that's ridiculous. Why would I put my money in that for 5 years and only get, X amount of percent return? Well, that same scenario today, like we were talking about, might be closer to 5%. And, if Fed raises, probably likely when the Fed raises the rate again another 75 basis points, we'll be turning around saying, wow, that same thing now is 7%. Is 7% low for a guaranteed, or 5% or 4%, whatever? Is that low? It depends on your need. What is it that you're looking for? Right now, so many people are looking for a cash alternative that needs some wrapper around it to guarantee a return, that's going to try to keep up somewhat with the pace of inflation. So it is that lower rate of return, even inside of this whole annuity myth, being annuity rates or returns are low, may very well be exactly what somebody right now is hoping and wanting and just needing to hear. So all across the board, folks, it's just one slice of the pie that may very well be suitable.
Yeah, I mean, there's just so many different kinds out there that, Uncle John probably wasn't aware of, and still may not be today until he comes on and visits us, is that, they all fit into that risk-reward scale, right? So how much risk are you willing to take is in a lot of ways determine what your upside potential, what your potential reward is. I mean, if we go through just the kind of the basic types of annuities, you have your immediate annuity, which we just, I think Ben referenced a couple minutes back. Give an insurance company X amount of dollars, and they will guarantee you a payment of that for however many years you seek it. And there's some rate of return built into that, but it's not going to blow your hair back. It's not going to be a phenomenal rate of return because the insurance company can't do anything with the money. They're immediately in a payout to you, right? But what it will do is guarantee those payments, and they'll come to you or to your survivor no matter what, right? So very little risk, very little reward, but predictability is built into it. Guarantees are built into it. Then you have your CD style, fixed annuity, which we've talked about here, pretty extensively, where you just get a guaranteed rate over a guaranteed period. Very vanilla, very simple, very predictable. Then you have your indexed annuities, which have a 0% floor, which means, and this is broadly general statement, so there's some variation here, but regardless of what happens in the market, you won't lose any of your principal investment, but year by year, your upside is going to be capped. Right, so there'll be only so much you can make no matter what happens in the market. And right now, this cap's around 9%, which that's pretty decent opportunity with zero risk.
Dan, that's a really good point. I mean, with having that zero risk option and such a decent cap, it really begs a lot of people to consider, hey, listen, what are the other options? The next step is the variable annuity we mentioned earlier, where you're fully exposed to the market, up, down, good, bad, or indifferent, ugly. It's there. It's, you think, hey, I think the market's going to rise, and I don't want to be limited by a 9% cap on the S&P. I don't see that as much of a limit. That's my sarcastic joke there. So the variable annuity gives you that exposure, but then you get into that kind of, well, what are the fees? And that's myth number 2, right? So myth number 2 is annuities are expensive. Not all annuities are expensive. Matter of fact, not all annuities even have fees. Right. So when you really break down annuities being expensive, it's why are some annuities have fees and why do some not have fees? And there's a lot of different reasons for both of those. When you actually buy an annuity, it means the word annuity means guarantee to pay. And when you want to start guaranteeing things, or you want to guarantee lots of things, there's a cost to that. There's actually different financial instruments that insurance companies will buy in the investment world to offset those concerns or those risks that you want to mitigate or you want to take out of your investment portfolio. Now, in the variable space where you're really starting to just engage a very direct exposure to a mutual fund sub-account, some sort of investment that's purely tied to the market. Good, market's up 40%, you're making 40. Market's down 40%, you're losing 40. If you're okay seeing that kind of volatility in your investment space and you say, but I still want to guarantee myself some sort of income, or I still want to guarantee myself some sort of death benefit, there's certain types of those riders, as they are called, that you can do, that you can actually say, I want to engage and how much risk you want to take. You might say, I want a guaranteed death benefit no matter what happens in the market. Or if the market, as long as it stays above zero, I'm willing to take that risk on. That might cost a little less. And you start engaging the various insurance companies that offer these, and you start picking and choosing what you're willing to pay for how much risk you're willing to absorb, same as the market and these fees. And then you get to the fixed index annuity world, Dan. As you mentioned, it has anywhere from 8 to 9. I've even seen higher caps than 9, where you say, hey, listen, I have no risk in the market, but I have no fees. And where does the insurance company make money? Well, they're hedging the market and they're making money on the caps. They're figuring out that, hey, listen, 9% is the number. We can still make money by buying options and offsetting that. Things you don't need to worry about because it's insured and it's guaranteed. But you can also buy kind of that hybrid space where you can get into a little bit more direct market. It's considered a variable annuity. It's a structured annuity. And you have caps that are similar and so forth, but they're usually higher, 13, 14, maybe 15%. Some are up 20. It's crazy. But they only absorb a certain percentage of how much down in the market it is. So the more risk you're willing to take, but those things usually have no fees, but you can start adding income riders that start adding fees. So these things are very smorgasbord-like, hey, I want cheese and crackers, but I don't want that salami because I don't like that flavor. It's like you can really start picking and choosing and really getting very detailed, which is exciting because you can pay for exactly what you want.
Yeah, I mean, these features are very much a la carte these days. I mean, you're like reading off a menu. So you want a guaranteed income that's going to increase over time, here's your cost. You want a guaranteed death benefit related to either my initial premium or some peak value I achieve over the term of the contract, there's a charge for that. I want to be able to, exit the contract if I have a nursing home experience, there's a cost for that. I want my income to increase if I suffer a health event, a cost for that. So you can make an annuity expensive if you go out and purchase each and every feature that's available, but they don't have to be that way, and they're not all built that way.
Yeah, I'm having fun actually with this whole topic again, bringing it back to Uncle John. Oh my gosh, Uncle John, we love you, man. But before I jump in on this next piece, we're going to take a break. It's time for us to do that really quickly. We're talking about debunking Uncle John's myths, and right now we're focused on the annuity world. We'll be right back. You're listening to Money on Tap.
Do you have an annuity? Do you understand exactly how it works and when to use it? The likelihood is that you don't, or maybe you bought it a while ago because at the time it sounded like a good idea. But will it accomplish your goals? We are here to help you. Contact us about a free annuity review and learn what your annuity does and how it can best help you in your retirement goals. It's absolutely free to you. And if there's a better way for you to accomplish your goals, this is a great way for you to learn about those opportunities too. Take the time to get educated, get empowered, make your retirement a success. Call us at 855-226-8551 or info@yourmoneyontap.com.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about debunking Uncle John's myths today, focusing on the annuity space. It's It's an area that if you are a three-dimensional advisor, or if you're working with somebody that is doing what we do, which is looking at you, your situation, and bringing everything to the table that's important to accomplish your goals. That includes insurance, annuities, brokerage, fee-based planning. All of it is important for you. And one of those spaces is the annuity space. And we just get we have so many fun conversations around this because there's just myth after myth after myth. And Uncle John loves to go ahead and tell tales around, what he knows in this world. And that's what we're doing, is we're talking about what the myth is around right now, the cost of annuities, or annuities being expensive. And as Ben and Dan were talking about this, I just was envisioning what Uncle John's experience must be here, because I bet you anything, Uncle John was, minding his own business on a, Tuesday evening, and, got interrupted at the dinner table as somebody knocked on the door. And guess what? They had an amazing opportunity for him, which just happened to be in the form of an annuity. And without really even understanding who Uncle John is and his needs or any of those kind of things, they just roll out this Mercedes-Benz AMG, fully decked out, loaded to the gills annuity for him, which, of course, all of the bells and whistles is incredible. Like we call them riders in this world, is there just the add-ons of things that accomplish different, whatever the need is. Maybe it's a death benefit. Maybe it's a guaranteed payout. Maybe it's whatever that looks like. You can add a million things to these if you want to. And so Uncle John looks at that, and then he sees, well, what's the cost, right? Well, of course, it's a lot. And maybe that is something that somebody needs, because it is an important thing to recognize that these exist in different ways for people that have specific needs. Those things cost money. So there's all sorts of different sides. And we're not saying that the investment, the one that has no fees is a Yugo that you have to, try to figure out how to, kick down the road or anything. They're just a different kind of a vehicle built for different speeds, different tracks, or different, outcomes.
Yeah, no, I think when we get to myth number 3 here, which annuities benefit the insurance company, not the investor, I think that's kind of really hard to believe necessarily. I mean, obviously the insurance companies are in business to make money, but 32%, is the number, which is, the greatest fears about retirees outliving their investments. 32% of people, that's their greatest fear. That's their greatest fear. That's not their only fear. That's the number one, 32% of retirees. When you start thinking about that, probably is top 5 for 80% of retirees, not just the greatest one. Annuities benefit the investor very highly when it can resolve an entire fear. I think when you really break that down, that's just an astronomical percentage.
I mean, I just thought of it now, but that's a pretty decent offset to a fee, is the ability to sleep at night, right? Wouldn't you like to do that, as actually sleep at night? And, annuities creating that, whether if you don't have a pension, you're just on Social Security, whether that's a second or third tier of guaranteed income, just to get you to the place you need to be. I mean, what's that got to be worth to you? I mean, that's substantial, right? Yeah,
no, I think when you really start breaking it down, and people are saying to themselves, well, the market's down, I'll wait till it recover. You are completely wrong. I'm sorry. If you're saying, hey, I need to wait till the market recovers and then I'll buy my annuity, that is the worst decision you could possibly ever make, because you'll never buy it then, because you won't buy it now. The truth is the best thing you can do right now is when we're standing on that fulcrum. I talked about this last time. Standing on that fulcrum, and we're looking at either we're going down another 30% or we're going up 5 or 10, right? That's kind of what we're looking at. People, like any little thing teeter-totters that, you're just looking at that thing and that thing is just bouncing. I can just see as you're standing in the middle of that seesaw, man. That thing, somebody opens their mouth, the market goes down. Somebody opens their mouth, the market goes up. That is the worst place to be, and you need to lock in your certainty of what your needs are today, because if we go from 24% down to, and we cross that 30% threshold like we talked about before, we got a 4 to 5 year recovery time frame potentially. That sends us into a totally different economy, totally different stock market, a totally different time horizon. You should lock it in when uncertainty is its greatest, not when it's its least.
When you say lock it in, it's important. You're just establishing the floor.
Yeah.
You're not limiting the upside, right? If the market gets better over time, and a lot of these tools, they vary a little bit, but we have plenty of options that would allow you to secure a guaranteed minimum income based upon your initial investment. But if the market improves over time, so will your income.
Yeah, so you and your spouse, you lock in your income, off you go, and if the market does better, your income goes up. If the market does worse, your income stays the same.
Yeah, and so, I mean, the truth of it is, to this myth, right, Seth, there's always some truth in it. And I think we all just have to go ahead and acknowledge this, right? Insurance companies exist to make money.
That's the way it is.
They are trying to profit. There is no doubt about it. But the fact of the matter is there's not a single investment you can make. Mutual funds, stocks, bonds. They're all making money, right? Somebody's getting paid to offer you this investment. There's all kinds of fees built into these investments. There isn't necessarily a cost of buying a stock, but you have to trade it on a platform, and there's somebody there making money.
And the other piece you got to remember too is that they're companies that are in competition with each other. So it's not like you're only working with one company. They're all trying to gain your business. So that makes them, they try to cut their costs as low as possible. They try to make their benefits as big as possible. They're trying to attract you as an investor. So there's just the general capitalistic keeping them true to their word that's going to.
It's competitive.
Yeah, it's going to keep them in that way. I think the other thing that people need to understand is that when you're really looking at these investments as a whole, right? Do you want a company who's not profitable selling you an investment?
No.
You want somebody who's looking out to gain money from some perspective because that's going to keep them in business, which makes their guarantees even that much stronger.
Yeah, I mean, we engage all day long no matter what we're doing with, people looking to make money off of doing business with us. I mean, that's what drives our economy and how it all goes round. I think it's just essentially a built-in expectation of day-to-day life.
Annuities, every time I read this, it just kind of drives me nuts, and I realize why. It's because it's such a play on the other side of people's fears here, which is annuities benefit the insurance company, not the investor. I'm sorry, but when you bought gas, was there no benefit to it? When you went to the grocery store and you bought groceries, was there no benefit to it? When you went to college and paid for college, was there no benefit to it? Oh, I just proved myself wrong there. I'm sorry. No, there was. I'm just having fun. No, there was, right? And so what they're telling you is if Uncle John is telling you there's no benefit, that they only benefit the insurance company, and somebody buys that, Uncle John's calling him an idiot. I'm sorry. Uncle John, you're wrong. You are wrong. So, folks, we've keeping this show moving on. We've got myth number 4. The insurance company keeps my money after I die.
That's a good one. That's second to fees, perhaps the one I've heard the most. And it's just truly ridiculous. I mean, there's one instance in where that might be the case, and that's if you did a life-only annuity.
With
then immediately
zero guarantees.
With no guarantees. So you trade some money in for a promise of an income, and the maximum income they show you on a monthly basis is a life only, which truly mean
which ends when you die.
Yeah, when you die, life only, then the payments cease. Now, that is something that, I wouldn't say we've never done, but what we have done
one.
Yeah, you do it with all kinds of disclosure, and it's part of a plan. And people understand this is a vanishing asset to cover a fee that also ends when you die.
That's a great word, vanishing asset. That's a great word. It's a vanishing asset. There's nobody that buys one of these that would ever walk out of the door not knowing that was an existing scenario. It's usually a beneficiary. This is what happens because the beneficiary says, there's no money there. It's like, well, the person who bought it died. And yes, there's no more money there because that's what that was.
I mean, I've used it before to pay for a life insurance policy, because there's a little bit of return in there, so you can kind of reduce the cost to the insurance owner. But guess what? That cost also ended when they died.
Yeah. So it matched up perfectly.
It had it's very specific use, and it was a cost reducer for them ultimately. But yeah, I mean, it's just not the type of advice we offer.
This type of thing no one would ever leave the door buying anything like this in our office without having about 10 pages of disclosure.
Yes.
And a child, if they were older, their child being involved in the purchase of it. It's not a common purchase, and it's a one-off, and someone probably said, I thought my mom had all this money or whatever, and she knew probably exactly what she bought, but the beneficiary wanted the money. And it's the way it works.
It'd be like the same as taking the life-only option in a pension, right? You take the maximum payout because you don't care where the rest of it goes if you don't live that long.
Yeah, exactly. Number 5 here, the last myth we have here. I can rely on other investment withdrawals and don't need an annuity. Wow, guys, what do you think of that?
Sequence of returns.
Go to our website, brayshawfinancial.com or info@yourmoneyontap.com. Go to our resources tab, go down to the videos, and the first video, which we've listed there, is sequence of returns. It's 2 minutes. It's 2 clicks. It's just a second of your time, and honestly would be the best 2 minutes ever spent to compare 2 different people doing exactly the same thing at just a couple years apart in their investments and how drastically different it can really be. And that's what really drives this. Annuities are really in the same place, the same particular need, the same particular scenario as Social Security, pensions, and then there's annuities for income. And that's really where they're fitting the void. They're really filling in that foundational need. It shouldn't be part of providing for every ounce of everything you need. It's really just the core expenses. It's your heating, it's your electricity, it's your mortgage, it's your car payments. In retirement, you need a fixed guaranteed level of income that you can pay all of your current bills for survival, the food, the this, that, and the other thing, that Social Security is not enough for. And most people don't have pensions anymore. So this is just that component of taking care of that void so you don't have to do things that cause irreparable harm to your other investments when the stock market's down.
Yeah, I mean, it's just to provide, I use this illustration often when people's, we need to build enough income through those means, right? Social Security is predictable. We know what that's going to be. If you have a pension, that's predictable. We know what that's going to be. We can add the annuity on the top to secure what you have in mind as the minimum lifestyle you want to retain in retirement. We can create that. We can ensure it. If you have the assets enough, we can guarantee that you maintain that lifestyle. And then you market investments, which you need as well. Those are more for, hey, the market's up, I have a little more discretionary spending. I golf 2 extra times this week. Market's down, maybe I tighten the belt up a little bit and we go to 1 less restaurant this month. Whatever the case is. But, that feeds into the discretionary end of the retirement you want.
Now, these are things that are really developed and designed around, rounding out, right, completing the full picture. And unless you have, and here's, I think, the mindset piece that people struggle with in this whole scenario is not understanding a dynamic, shifting marketplace. Until we're in one, like now, where everybody's like, oh my gosh, you mean the market does not go up infinitely at 10% a year forever? Because that doesn't exist. You have to use other resources, folks.
Yeah, I think
that's what this is about.
Seth, it's interesting. There's a statistic that Social Security payments currently replace only about 42% of a median earner's income. 42%. So there's 58% more income needed on average to be replaced for people to pay their bills. 1 in 5 adults expect to work past age 65 because they haven't saved enough and they're concerned about their income needs because Social Security doesn't cover it. That's 1 in 5. So for when you're listening to our show and you're feeling insecure about your financial scenario or you feel like you haven't done enough or there's no judgment here. We're here to help. We're here to bring this to something where you can say, I don't need to work past 65 unless I want to.
Yeah, I mean, the old rule of thumb, and most of those old rules of thumb you can basically toss out the window, but, was that you need 70% of your, working era income to survive in retirement. And if Social Security is only getting you 42% of that, I mean, it's still significantly short. Where are you going to replace it?
Yeah.
Folks, that's going to do it for us at Money on Tap today. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We've been talking about debunking Uncle John's myths, focused on the annuity myths, and there's so much more out there that we can't wait to bring to the table with you. It's going to be a lot of fun. We'll see you next week.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.